The Wall Street Journal recently ran an article titled, U.S. Stocks are breaking records. The rest of the world is doing even better. What they mean is that U.S. stocks are up 16% so far year to date, but the rest of the world, the MSCI All World ex-U.S. index, is up 26%. That's like the biggest valuation gap in almost a generation. Foreign stocks are somewhere between 20% and 40% cheaper than U.S. stocks on a multiple basis. So, should you run out and buy them? Well, hold on. It's not so much that foreign companies are doing awesome operationally. In some cases, that's true. The South Korean market is up 65% year to date. That country is on a tear. But the real reason for the discrepancy is that the U.S. dollar index, the U.S. dollar is down. The index is down 6.5% year to date. And historically, times when the dollar is down are times when foreign stocks outperform. It's almost mathematical. Look at the 2000s. The U.S. dollar went down. Emerging markets went on a tear relative to U.S. stocks. Then 2008, 2009 happened, the great financial crisis. The dollar strengthened. We had about 16, 17 years of U.S. exceptionalism after that. But these days, the other factor is American exceptionalism is looking more like AI exceptionalism. The Mag 7 or Mag 10 is a huge part of the S&P 500, both in market cap and certainly in capital spending and growth. If you took out that proxy bet that the U.S. market has become on AI stocks, the valuation discrepancy between U.S. stocks and foreign stocks would be even bigger. So that's a little bit scary, actually. Now, why is the dollar going down? Well, people are scared. People are scared whether it's inflation in the U.S., whether it's foreign policy and tariffs. Who knows? I mean, there's a long list of things, but they're basically a little bit worried about the debt, about inflation, about all these things that could affect the U.S. economy in the long run. Now, what should you do? First of all, be careful of anyone who's overly confident about what's going to happen in this situation. Nobody really knows. In my opinion, this is a perfect time to diversify. I have about 20% of my portfolio outside the U.S. or in stocks outside the U.S., even if they're traded on U.S. exchanges. And by the way, 25% of the revenues of S&P 500 companies, come from abroad. Now, that's revenue diversification. It's different from market domicile diversification, right? You have the multiple difference when you're talking about domicile diversification, but same idea. You want to spread your eggs out, not all in one basket. If you find good quality companies, whether they're here or whether they're outside the U.S., and diversify in the long run, I'm pretty sure you're going to be okay.